JPMorgan didn't just buy silver, they removed it from the system. Millions of ounces disappeared quietly without anyone noticing, except the few who are paying attention. And if you understand the timing of this move, it might be the signal for a shakeout the market isn't prepared for. Today, silver has reached levels most experts didn't predict. $59.32 an ounce. Record-breaking. But here's the kicker. While the world was celebrating or shrugging, it seems one of America's largest banks quietly moved roughly 169 million ounces of silver into its vaults. That's about 9% of the entire global supply. Accumulated over 14 years. Quietly, methodically. It raises a question. If silver isn't important, if it's just another metal, why would one of the most powerful financial institutions in the world hoard it so aggressively? My theory, this isn't about speculation. This is about positioning for something much bigger. And to understand it, we need to look at a pattern that is repeated through every major financial crisis in history. This pattern is simple, but brutal. 4 stages. Always. Never fails. And in my analysis, silver is sitting in stage 4 right now. The eruption stage, let's break it down. Stage 1, the setup. This is when authorities create the illusion of stability. Paper markets are built, prices are suppressed, and confidence is artificially maintained. In silver's case, this setup began decades ago after the Hunt brothers saga in 1980. Regulators worried about volatility and created a paper market vastly larger than the physical market. Some estimates say 50 times larger. Here's the problem. According to open interest data, paper contracts now sit at around 244% of vaulted silver. That means if even half of paper holders demand delivery, the system would face stress it hasn't seen in decades. This isn't hypothetical, it's math, and it's real. Stage 2, expansion. Promises stacked on promises. Debt printing, market suppression. Yet industrial demand keeps growing. Solar panels, electric vehicles, AI centers, 5G networks, they all consume more silver than ever. Industrial demand now represents roughly 59% of total silver consumption, up from 40% a decade ago. But mining hasn't kept up. Supply has actually dropped around 7% since 2016. Where does the difference come from? Above-ground stockpiles, vaults, reserves, and JPMorgan has quietly been absorbing a massive portion. Estimates suggest they have accumulated up to 675 million ounces of physical silver since 2011, about 45% of the world's above-ground supply. That's more than the Hunts, more than Berkshire Hathaway, more than some countries. Stage 3, the break. This is where paper markets start to fail. Delivery becomes critical. Systems can't keep up. Illiquidity appears. Bid-ask spreads widen. Exchanges experience outages. On November 28, 2025, the CME Group reportedly went offline for over 10 hours due to technical issues. During that outage, silver spiked to 56.72. Chaos. And just days later, JPMorgan moved 13.4 million ounces from deliverable silver to eligible status. That means the silver is stored but cannot be delivered. 9% of the system's available physical silver suddenly became inaccessible. That's a red flag. A squeeze forming. Stage 4, the eruption. Prices explode, shorts get crushed. Institutions positioned correctly profit massively. Retail investors scramble. The Hunt's story in 1980 is the classic example. 2 brothers bought roughly a third of America's silver. Silver soared to $49 an ounce, an 800% increase in 18 months. The banks had to intervene to stop the surge. But this time, imagine if the reckless buyers weren't 2 billionaires. They were one of the world's largest banks. And this isn't speculative history. In 2008, paper mortgage securities collapsed when everyone wanted the real asset simultaneously. Gold surged from $720 to $1,903 in just 3 years. And silver? Following gold, but with more volatility, more explosive movement, silver is now consolidating just below $60. Targets set by JPMorgan, Citibank, and other analysts have already been surpassed. Conservative independent estimates suggest $75 to $90 by the end of 2026. But the real question is, what happens if the paper market breaks under strain? History shows us only one thing. Scarcity drives chaos. Right now, the physical silver market is signaling something dangerous. It's not the price on paper that matters. It's the scarcity of the metal itself. Dealers are reporting rising premiums. Some are facing delays. People are scrambling to get coins, bars, anything tangible. And for those paying attention, this isn't random. It's the first visible sign of a system under stress. Registered silver, silver available for delivery, has been draining rapidly from exchanges like COMEX. Current reports suggest around 113 million ounces remain, but at the current pace, this could fall below 50 million ounces within months. That's when stress truly starts. Not in theory, not in spreadsheets, but in the real world where contracts might fail to deliver. Now, let's layer in the macro picture. The Federal Reserve is meeting in just a few days. Bloomberg data shows a roughly 87% probability of a rate cut. Historically, when rates fall, the dollar weakens. And when the dollar weakens, precious metals spike. Gold is already trading around $4,000 an ounce, with analysts projecting $4,500 to $5,000 by mid-2026. Silver historically follows gold, but it moves faster, more volatile, more explosive. And if physical supply is already constrained, that volatility becomes extreme. Think about the mechanics. JPMorgan holds an enormous stake in physical silver. Structural deficits mean demand exceeds mined supply for 7 consecutive years. Industrial demand keeps climbing. Solar panels, EVs, electronics, all these industries are consuming silver faster than it can be mined. And now a Fed rate cut could act like a spark on top of this tinder. This is where the stress points become crystal clear. Let's break them down. 1. Vault accumulation. Major banks have hoarded enormous quantities of physical silver. The system is dependent on paper promises, but physical metal is shrinking. 2. Industrial demand growth. Silver consumption in industry now represents nearly 60% of total use. That trend is unlikely to reverse. 3. Paper market leverage. The paper market is massive, many multiples larger than actual metal. Open interest exceeds 240% of physical silver. If even a fraction of paper holders demand delivery, chaos ensues. 4. Exchange liquidity strain, COMEX outages, bid-ask spread widening, and delivery delays have already happened. These are real-world warning signs. 5. Global political and economic tension, trade disputes, geopolitical instability, and inflationary pressures add uncertainty. The stress isn't isolated, it's systemic. History gives us a framework to understand the danger. In 1980, the Hunt brothers cornered a massive portion of the U.S. silver supply. Prices exploded, banks panicked, and rules changed overnight to stop the squeeze. That was one crisis. Today, the system is far more fragile. The paper market is larger, industrial demand higher, and the physical shortage more pronounced. This is the convergence point. Scarcity, macro catalysts, and strategic positioning all collide. If registered silver falls further and the Fed acts, the potential for a violent price move is significant. And unlike 1980, it isn't a couple of billionaires creating the squeeze. It's a bank with the resources to play the system with near-perfect timing. The implications are enormous. If delivery fails, premiums could spike 30%, 40%, even 50% over spot price. During the COVID panic in 2020, silver hit around $28 on paper, but coins were selling for $40, a 60% premium. Now imagine that scenario with silver trading above $100. The math is simple, the risk is obvious, and the warning signs are all in place. And here's what most people miss. This isn't just about silver. Silver is a symptom. The underlying problem is the dollar. Since 1971, the dollar has been purely fiat, backed by confidence but not by physical assets. Decades of deficit spending, monetary expansion, and suppressed interest rates have created an environment where the system can no longer absorb stress without dramatic price signals. Institutional money is already moving. Alternative assets are gaining attention. The market is signaling the same story in multiple ways. Scarcity matters. Real assets outperform paper promises when trust in the system wavers. Silver might be the most undervalued and underappreciated scarce asset right now, undervalued relative to gold, relative to industrial demand, and relative to the massive growth in the money supply. And this isn't theoretical. 45 years of suppression, accumulation, and coiling have led to this exact moment. Silver is climbing past $15. Structural deficits persist. Bank accumulation continues. The paper market is showing stress. Fed meetings, geopolitical tensions, and industrial demand all converge. This is not a drill. This is the setup for a shakeout. And JPMorgan's strategic hoarding isn't coincidental. It's a calculated move in a system under pressure. History is rarely subtle. In 1980, the Hunt brothers bought a massive portion of America's silver supply, betting on fundamentals everyone else ignored. Silver soared from $6 to $49 an ounce in just 18 months, an 800% gain. Banks panicked. Exchanges changed the rules overnight, forced liquidations, destroyed fortunes. But the lesson wasn't about greed. It was about scarcity. When demand exceeds supply, prices spike. Period. Fast forward to 2008. Paper markets collapsed when everyone wanted the real thing simultaneously. Gold surged from $720 to nearly $1,923 in 3 years. Silver followed, more volatile, more explosive. The lesson? Paper promises fail when trust erodes. Real assets win. Now, combine these historical lessons with today's reality. Structural deficits, industrial demand surging, record high accumulation by JPMorgan, and a stressed paper market. Then add the upcoming Fed decision, a potential rate cut that could weaken the dollar, and the stage is set for a final silver shakeout. Let's consider possible scenarios. 1. Mild correction. Paper market absorbs pressure. Premiums rise modestly. Physical silver moves slightly higher. The system survives, but stress points grow. 2. Moderate shock. Delivery failures begin. Registered silver drops below critical thresholds. Premiums spike 30-50%. Retail investors scramble. Institutions positioned early profit massively. 3. Full shakeout. Paper contracts cannot be delivered. Physical demand overwhelms supply. Prices explode, $100, $150, possibly $200 per ounce. Latecomers face chaos. The market resets, trust fails, and the rules are rewritten in real time. This is why every data point matters. The COMEX registered silver is already dwindling. Dealers are raising premiums. Industrial demand continues unabated. JPMorgan's vaults are strategically positioned, and the Fed's decision is days away. Here's the cold, hard truth. This isn't speculation. This is the convergence of predictable patterns, repeated across decades, now amplified by modern market scale. If you're watching the system without understanding these signals, you could be caught off guard. The final shakeout isn't about hype. It's about fundamentals colliding with structural imbalances. The stakes are clear. Early movers win. Latecomers scramble. And the market will punish those who ignore history. Now imagine the scenario in slow motion. Physical silver becomes scarce. Prices spike. Paper markets fail to deliver. Institutions positioned correctly profit handsomely. The rest scramble to buy at a premium. Exchanges are strained. Systems falter. And the normal market no longer exists. This isn't fear-mongering. It's analysis. And the choice is yours. Watch and learn, or ignore and risk being left behind. December 9th, the Fed meeting, is the first domino. Structural deficits, industrial demand, bank positioning, and paper market stress are the tinder. One spark could ignite a chain reaction. When silver hits $100, $150, or even $200 per ounce, those positioned correctly will have been in place for years. Those who underestimated the signals, the timing, the structural deficits, the scarcity, will pay the price. The Hunt brothers were early. JPMorgan is patient. They've learned from history. They won't rush. They'll let the market work for them while the system strains under its own weight. And here's the key takeaway. Silver is more than a metal. It's a mirror for trust in the system. When physical supply tightens, paper promises fail, and money flows to reality. This isn't speculation. It's the inevitable consequence of the imbalance we've been tracking for years. The choice is simple. Position yourself to understand what's unfolding. Follow the signals. Track supply, industrial demand, vault accumulation, and macro catalysts. This is a historic moment. The silver situation isn't coming. It's already here. The question isn't if the shakeout will happen. It's when and whether you're ready. Record highs, structural deficits, bank accumulation, Fed meetings, geopolitical tensions, all these factors converge now. The pattern is complete. Stage 1, setup. Stage 2, expansion. Stage 3, crisis. Stage 4, eruption. We are on the brink. The final silver shakeout is here. The window of opportunity is shrinking. And while nobody can predict the exact day or price, history gives us a reliable guide. Scarcity wins. Physical supply matters. Trust is fragile. Timing is everything. Now the decision is yours. Will you simply watch, or will you pay attention to the forces shaping the next historic move in silver? December 9th may mark the beginning of the final shakeout, and those who understand the signals will be positioned to see the move others will only read about later. The story is unfolding. Scarcity, positioning, macro catalysts, they all point in one direction. The silver shakeout isn't a question anymore. It's a countdown.